March 10, 2023. Silicon Valley Bank has $42 billion in customer deposits and roughly 16 hours to live. By sunrise, the California Department of Financial Protection will seize control of the 16th largest bank in America. By noon, the FDIC will be standing in the lobby with cardboard boxes. By Monday, every finance professor in the world will be on television explaining how this couldn't have happened. But here's what nobody mentioned during the panic. The government didn't save Silicon Valley Bank. It didn't bail out the shareholders. It didn't write a check to make the problem go away. Someone else did, and that someone has the power to create unlimited money instantly without asking anyone's permission. When a bank runs out of cash, we imagine dramatic scenes, government helicopters, emergency legislation, the Treasury Secretary on speed dial with the president. But the actual rescue looks nothing like that. It's quieter, stranger, and it happens through a mechanism that sounds too boring to be dangerous. The Federal Reserve runs something called the discount window. Think of it as an emergency ATM for banks. When a bank is about to run out of cash, this is where it goes. And the discount window is where banks go to die slowly instead of quickly. Here's how it works. Every bank in America keeps two kinds of money: the cash you can withdraw from an ATM and the assets they've invested your deposits into: mortgages, treasury bonds, corporate loans. Normally, this works fine. You deposit $100. They lend out $90. Everyone's happy until everyone wants their money back at the same time. When that happens, the bank has a problem. They can't sell a 30-year mortgage in 6 hours. They can't liquidate a bond portfolio during a panic without taking catastrophic losses. So they do what any rational institution does when it's about to collapse. They call the Fed, and the Fed says yes. Not because they like the bank, not because the bank made good decisions, but because if they say no, the contagion spreads. One bank failure becomes 3. 3 becomes 12. 12 becomes a system-wide meltdown that makes 2008 look like a practice round. So the Fed opens a discount window. The bank hands over collateral, bonds, mortgage-backed securities, anything with a balance sheet value. And in exchange, the Fed gives them cash. Actual liquidity, enough to survive the day. This is the moment where a private mistake becomes a public problem. This isn't a bailout. It's a loan with interest, with terms, with a very real possibility that the bank doesn't stabilize, the Fed will own a pile of assets nobody wants to buy. But here's the part that makes this system so strange. The Fed doesn't take money from taxpayers. It types new money into the system on a computer. That money didn't exist the day before. No congressional approval, no political theater, no budget constraint. One keystroke, and a bank that was insolvent an hour ago now has enough cash to open its doors. Let's go back to March 2023. Silicon Valley Bank had spent the previous 2 years making a bet that seemed perfectly reasonable. Interest rates were near zero. They took customer deposits and bought long-term treasury bonds. Safe, stable, backed by the full faith and credit of the United States government. Then the Fed raised interest rates. Fast. 11 times in 18 months. The fastest tightening cycle in 40 years. And suddenly, those safe treasury bonds were worth 30% less than what SVB paid for them. Not because the bonds were bad. Not because the government was going to default. But because new bonds were paying higher rates. Nobody wanted the old ones anymore. The bank had locked money away for 10 or 20 years, but customers wanted their money back today. That timing problem is what killed the bank. When venture capital firms started quietly telling their portfolio companies to pull their deposits, the math stopped working. Within 48 hours, customers tried to withdraw $42 billion. SVB had $1 billion in cash, so they called the Fed, and the Fed said yes. Sort of. See, by the time SVB picked up the phone, it was already too late. The bank run had gone viral on Twitter. Founders were wiring money out in real time. Depositors were showing up at branches demanding cashier's checks. The discount window could slow the bleed, but it couldn't stop it. On Friday morning, regulators pulled the plug. But here's where it gets weird. The FDIC seized the bank, took over operations, fired management, then immediately announced that every depositor would be made whole. Not just the accounts under $250,000 that are federally insured. Every single dollar, including the venture capital firms with $50 million sitting in checking accounts. And everyone said the same thing. Bailout. The government bailed them out, except they didn't. The FDIC didn't use taxpayer money. They used something called the Deposit Insurance Fund, a pool of money collected from fees that every bank in America pays for the privilege of having FDIC insurance. When Silicon Valley Bank collapsed, the FDIC dipped into that fund, covered the deposits, and then sent a bill to every other bank in the country, a special assessment. Pay up, your competitor screwed up, and now you're covering the tab. JP Morgan Chase paid hundreds of millions. Bank of America paid hundreds of millions. Small community banks in Iowa paid tens of thousands, not because they did anything wrong, but because the system is designed so that banks rescue each other. It's peer-to-peer bailouts, socialized loss, privatized profit, with a government agency acting as the middleman. And it worked. Depositors got their money. The financial system didn't collapse. Politicians got to say they didn't spend a dime of taxpayer money. Technically true, profoundly misleading, because the cost didn't disappear. It just moved. Now zoom out. This isn't new. The discount window has existed since 1914. The whole point of the Federal Reserve was to prevent bank runs, to be the lender of last resort, to make sure that a temporary liquidity crisis doesn't turn into a permanent solvency disaster. And for 100 years, it mostly worked. But something changed after 2008. The discount window became a permanent fixture, not an emergency tool, but a subsidy, a way for banks to keep functioning even when their business models didn't make sense anymore. During the pandemic, the Fed lent out trillions through various emergency facilities. The discount window, repo operations, quantitative easing. They bought corporate bonds, mortgage-backed securities, municipal debt, anything to keep the machine running. And it worked. Markets stabilized. Banks survived. The economy rebounded. But the cost was invisible. Because when the Fed creates money to rescue banks, it's not spending taxes. It's expanding the number of dollars in existence. More dollars chasing the same goods, which eventually shows up as inflation. So, who actually paid for Silicon Valley Bank? Not the government, not the shareholders, not even the FDIC, really. Everyone who holds dollars paid for it. When new money is created, prices slowly rise. That means your money buys less food, less rent, less fuel. That's how regular people end up paying for bank rescues. A little bit, silently, over time. Here's the uncomfortable truth. The system we built doesn't allow banks to fail anymore. Not big ones. Not politically connected ones. Not ones whose depositors are influential enough to make noise. We've created a world where rescue is automatic, where the discount window is always open, where liquidity is infinite as long as you have collateral the Fed is willing to accept. And that creates a problem. If banks know they'll be rescued, why be cautious? Why hold extra capital? Why turn down risky loans? The upside is yours. The downside is everyone else's. This is called moral hazard. It means if you know you'll be rescued, you take bigger risks. It's like driving faster because you know someone else will pay for the crash. And the truly strange part is that most people don't even know it's happening. The discount window doesn't make headlines. Emergency lending facilities get announced in dense press releases that nobody reads. The mechanics of how banks get rescued are hidden behind acronyms and technical jargon that sound boring enough to ignore. But it's not boring. It's the most important subsidy in the modern economy. A silent guarantee that if you're big enough, connected enough, or systemic enough, someone will answer the phone when you call. And that someone isn't the government. It's the central bank, using powers that most people don't understand, creating money that didn't exist, reshaping the economy in ways that won't show up until years later. So the next time you hear about a bank on the verge of collapse, don't ask if the government will step in. Ask who's already on the phone with the Fed, because the rescue started before you even knew there was a problem.